Hello, Real Estate George here again. So, last week we talked about Pag-ibig being the best loan option for properties less than 6 million pesos. And as mentioned, it has its own inherent limitation, like it's only exclusive to members, and not to mention the strict compliance of documents and credit investigation. But what if you have the money but do not have the documents? What if you have a history of unpaid loan or ran away from a credit card payment? What if your foreigner boyfriend or spouse will finance the property for you? Ladies and gentlemen, this is where the in-house financing comes to your rescue. But before we proceed, if this is your first time in this channel, please don't forget to subscribe and hit the notification bell so you'll be notified for future videos in this channel. Alright, so what is in-house financing? In-house financing are loans direct from real estate developers to acquire a condominium, a townhouse, or a house and lot. Technically, they are not loans, they are just extended payments offered by developers to eliminate buyers' reliance on financial institutions like banks or Pag-ibig to complete a transaction. Sounds awesome, right? Now, why do developers offer in-house financing? Easy. It helps developers capture the buyer market segment that have been rejected or might not have been qualified to Pag-ibig or bank loan, allowing them for more sales. How do real estate developers offer in-house financing? Well, they do this in two ways. Either they have an in-house credit department that provides financing directly to their clients, or they partner with a single third-party credit provider to service loan for their clients. So, let's explore the pros and cons of an in-house financing to better give you an idea if the pros outweigh the cons and if you think that in-house financing is the best option for you. Let's start with the cons. First is higher interest rates. The interest rates available with in-house financing are higher than those found with more traditional outside lenders. They are usually at a range of 10 to 20%. This represents the risk that developers are willing to take if the home buyer will not completely pay off the agreed total contract price of the property, and that if you choose in-house financing, you will end up paying more than if you were to get financing from a bank or Pag-ibig. The other con is that in-house financing terms are only up to 10 years. Relative to the first disadvantage of an in-house financing, which is higher interest rate, the shorter payment makes up the one-two punch that can hit your pocket hard. While in-house financing carries huge risk for both the borrower because of the high interest rate and the developer, that's why they want to have a shorter payment term. This option is not so bad at all. As mentioned, this option addresses a very specific home buyer demand. Home buyers whose loan have been rejected or might not have been qualified for Pag-ibig or bank loan. Now let us look at the pros of an in-house financing. The first one is easy to apply. In-house financing does not require much paperwork outside your certificate of employment or source of income. Developers that offer in-house financing are more tolerant to risk and are willing to work with a lower or lacking credit rating in order to get you the property you can afford. As such, there is low risk for your loan to get denied, even clients with bad credit or no credit history. In short, lesser requirements, faster approval. The next one is fixed interest rates. Now we have already established that in-house financing offers a higher interest rate. The good news is that these rates are fixed. Thus, it is not subject to economic volatility unlike that of the banks or Pag-ibig. The third advantage is that in-house financing helps build credit. It allows clients with bad credit to rebuild their credit standing over time. Now, if you look at just the pros and the cons, you can easily tell that in-house financing is easier to apply and get approved, but it is more expensive due to the high interest rates. Now, speaking of higher interest rates, there are actually ways to work around these higher interest rates. And one of them is to increase your down payment and pay the above minimum monthly payments. But we must admit this, some of us don't really think about our credit worthiness as important, not unless we need it for a housing loan. We don't even care about our credit score or building a good credit history, not unless we need it for a housing loan. What I'm trying to say is that in-house financing can be our best way to getting our dream property easier and faster. More expensive? Yes, But the other option is to wait for a couple of years so you can build your credit status to be eligible for a bank loan or pag-ibig loan. And when you are already qualified, your dream house is already taken. In summary, in-house financing is your best option if you have the money but do not have the documents needed by banks and pag-ibig. In-house financing is your best option if you have a history of unpaid loans or you ran away from a credit card payment. And in-house financing is your best option if you will be financially assisted by a foreign spouse, parents, or relatives. So if you fall under these categories, consult with your real estate agent to find your projects from developers that offer in-house financing in your area. So there you have it. Once again, this is George Ryan Sarmago, Unit Manager of Philippine Homes and a PRC registered and DHSUD accredited salesperson. Thank you for watching. Stay safe, stay at home, and peace.